Hello and welcome into the KE Report. I'm your host, Shad Markowitz, and I'm speaking today with Jordan Roy-Byrne, editor and publisher of The Daily Gold. We'll put a link to The Daily Gold down below this editorial. And Jordan, it's always great to have you on the show to talk about the markets, to talk about the precious metals. And I guess we should kick off with the gold and silver prices have done pretty good the last couple months. Today, as we look at the markets, gold is up again after having a big day yesterday. And it seems to have been on a good trajectory ever since bottoming in November. If people recall, November 4th, gold got all the way down intraday to 1618. It quickly tacked on $200, but a lot of people are expecting that to roll back over. What we have seen is a continuation of this move higher. Currently, gold's around 1858. Do you think this move has more legs to it, or is there any key resistance levels you're looking at? What has your attention as far as gold and silver right now?
Yeah, I mean, it might have a few more legs to it. I would be more bullish in the immediate short term if silver didn't reverse course in the last day or two. So silver yesterday put in a potentially bearish reversal candle, and today we're seeing it again. So the last two candles for silver are kind of ugly. And typically at the end of short-term moves, you start to see silver lose steam. Now, this weakness we're seeing in silver over the last 48 hours, that could be an indication that this move is about to end right now, or that it's an indication that the move is slowing down and will probably end soon, but not necessarily right now. So I know that doesn't answer the question, but either way, I think the relative weakness of silver right now is a sign that we're coming to the end of this move. Looking at gold's technicals, it did hit 1870 earlier today. It's coming off. I mean, the levels I've been talking about the last week or two were 1840 and 1870. And so gold was able to push above, really surge above 1840 yesterday. Today it hit 1870 in the morning. So it is possible that we may have seen the high today, or like I said just a couple seconds ago, we could have another little push higher. I mean, 1900 is really stiff resistance. So if gold's able to see more buying and clear 1870, you'd probably see it come close to 1900. So best case scenario in the very short term, I think, is that would be it. Gold is able to go above 1870 and come close to that resistance at 1900, which is really stiff resistance. Looking at the stocks, I did have an upside target of 42 for GDXJ. I'm a little concerned that we could see a reversal tomorrow or the next day. But if we don't see a really hard reversal in the next day or two, then I think the GDXJ does have a chance to get to 41, 42. So those would be the targets that I'm looking at. So nice move that we've had in the very short term. It's possible there's a little bit more upside here, but either way, I wouldn't be chasing this as far as being a short-term trader.
Well, and that kind of sets us up for looking at more of the medium-term picture. There's a lot of investors that have had cash on the sidelines. They've been waiting to get back in. Maybe they missed this recent move over the last couple months in gold and silver and the mining stocks, but at this point, it doesn't sound like it'd be a spot they would want to pile in because the risk of things pulling back is just too great. We've had a couple people on the show, Jordan, that thought we're going to see another deep pullback in the next couple months. But this is also a time of year, beginning of the year, where there's a lot of portfolio reshuffling and people kind of enter the new year and take on new positions. Would you wait if you had cash on the sidelines for that pullback? And where do you think things could pull back to if that's what plays out over the medium term?
For me, it's really stock specific. That's what it comes down to. I know I don't talk about individual stocks, but that's what it means. I mean, what are you looking at something that has moved 50 or 60% already, or are you looking at something that has maybe just started to move and is only up 20% off its lows? I mean, it depends on the size of the company as well. But I think if you're looking at a lot of gold and silver juniors that really haven't moved a whole lot and they're kind of on the smaller side, I mean, you're going to be okay with accumulating those. At the same time, if you're looking at larger stocks that are up considerably off the bottom, for the most part, I wouldn't chase those in the very short term. If you absolutely feel like you have to buy something, I mean, you can buy it in small increments. You don't have to do a huge buy today, but that's what I would do. So it's stock specific. And then if you're a little gun shy or, feel like something's up too much, but you really feel like you have to buy it now, just go with a very small buy to get your feet wet.
What about if people are just tracking the ETFs, GDX, GDXJ? If they were to roll over, are there any targets for support where you think it'd be a good entry point?
Yeah, I mean, for GDXJ, right now it should have pretty good support around 35, maybe 34 and a half as well. However, if we're looking at this price action, it did have a little breakout here, and there were a couple things pointing to 42. So if GDXJ is able to get to 41 or 42, then maybe the support after that comes down to 36 or 37. So I don't think we're going to see any huge pullbacks in the sector. I mean, that's the difficult thing. I mean, you see a market bottom, and then it has a pretty good move. It comes off the bottom, it goes up a little bit more. You're waiting that thinking it might retest the bottom or have some 30% pullback. We're not going to see that kind of a pullback. I mean, we might see in the minors, maybe in individual stocks, you could see, a 15% or 10% pullback. But I don't think that we're going to see some huge pullback. That's the difficulty. I mean, when the market does correct, it's probably going to, it could correct more in time than price. I don't mean to kind of be unequivocal, but it's just when you're coming off a bottom, you're in a new uptrend, you have to be really careful about expecting huge pullbacks because they just don't happen. And pullbacks can happen really quickly in individual stocks. Like you can take an individual junior and you're thinking, okay, well, I'm waiting for this to correct 20 or 25%. Well, maybe it corrects 17% really quickly in 1 week. And then you miss it, and then it rebounds and it's back and it's moving higher again. So these are the scenarios I think that people have to worry about when you're early in a new bull market. You've come off the bottom. I just don't see a huge pullback coming.
Yeah, if you're in a new bull market, the pullbacks are usually more shallow and shorter than people expect. I guess let me just tie you down on this then. We've had a couple of folks we've talked to recently that still believe there's another leg lower in the precious metals, and they don't believe the bottom is in. What gives you confidence that the bottom is in and that we are in that new bull leg higher now?
Well, number one, what you just said, the fact that there's still a lot of people out there I mean, respectfully speaking, I don't know how you could think there's another leg lower. I mean, technically, fundamentally, looking at sentiment, there's just, unless you're misinterpreting things, there's just nothing that points to another leg lower. I mean, respectfully, that's just ridiculous, in my opinion. But in addition to that, if you're let's look at gold in real terms. Gold has been performing even better in real terms than nominal terms. Look at gold against foreign currencies, look at gold against the S&P, look at gold against commodities. All these ratios are above upward sloping 200-day moving averages. So all these trends are actually more established than gold in nominal terms. And that's typically what you see at the start of a bull market or a big move. You see gold is strengthening in real terms. That happens ahead of gold in nominal prices. I mean, if this market were about to roll over and go to new lows, gold would be really weak in real terms. Gold is outperforming everything. I mean, I just said it. And we could mention yesterday, the dollar had a big move. Gold was still up. Gold against foreign currencies, I think it's up again today. It's only 4% away from an all-time high. When that makes a new all-time high and holds it, every time that's happened except once in the last 30 years or so, gold in nominal terms has made a new high in the next couple months or 6 or 8 months. So technically, even though gold is coming up on significant resistance at 1870 to 1900, everything else technically looks really positive to me. And fundamentally, which is obviously even more important, I think gold is sniffing out that the next Fed policy or the next developments in the economy, whatever you're looking at, it's gold bullish. And here's why. Let's say the economy goes into recession, which is likely. The question is just the timing. Is going to be a couple months or 6 or 9 months. The economy goes into recession. The Fed, I mean, their rates are almost at 5%. They're going to have to cut rates. So that's gold bullish. That's bullish for gold above everything else. In that scenario, you want to own gold and gold miners. You don't want to own energy or copper, etc. So that's, in my opinion, partially why gold is so much stronger in real terms right now than everything else. And let's think about the other scenario. Like, let's say the Fed is able to hike more than people think. They can hike to 5.5% or whatever. I mean, that means inflation is not coming down fast enough. So in that scenario where the Fed has to keep hiking, that would mean that inflation is really embedded in the economy at 4 or 5% a year. And so that's really stagflationary. And even if that's the case, at some point the Fed would have to cut rates. And so that's the catch 22 that I think the Fed is going to come to at some point this year, which is inflation is not going to come down to 2 or 3%. And we don't want to hike this economy into a depression. Like, we just can't afford to do that. And so at some point, the Fed is just going to have to pick the lesser of two evils and start to cut rates as the economy likely rolls into recession. And that's going to happen with, again, inflation not at 2 or 3%, but maybe inflation coming down to 4 or 5% a year. And so I think that's what gold is starting to sniff out a little bit. And to me, a lot of breakouts in gold in the last 20 or 30 years happened when the Fed had to cut rates or when they cut rates. So for me, I think at some point this year, the Fed is going to have to cut rates. And that's when you're going to see gold make this hugely significant historical breakout, above 2050 or 2100 an ounce. So looking at all these factors, I really don't see a bear case for gold. And just, a couple other things I'd like to add, which is really important. Think about all the negative developments gold has endured in the last 12 or 18 months. Number one, the dollar. The dollar at one point had made a 30% move higher over a 17-month period. That was the case up until 3 months ago. A 30% move higher in the dollar. You had that. In addition, you had real interest rates, looking at the TIPS market, which started in the late 90s. I looked at the real 10-year yield, which analysts say this is the best indicator for gold as far as real interest rates. The real 10-year TIPS yield, if you look at that, it has increased something like 2.6 or 2.7%. That's the largest increase in the last 25 years or so in the real TIPS yield market. So real interest rates have been surging. And in addition to that, you have the Fed. I mean, it's related, but the Fed, basically the second biggest and sharpest Fed hiking cycle ever. You had 3 major negatives for gold, and look at where it is now. I mean, you had these 3 major negatives, and gold, the lowest it went to for a little while. I mean, what was the lowest monthly close? It closed below 1,700 like for 1 month. I mean, given those 3 major negatives, you would think gold probably would come down to 1,300 or 1,400. Now, those things are starting to pass. Now, gold is, I mean, it hit 1870 today. It's not that far away from these really significant levels. So, and it's had a big rally in the last couple of months. That in the face of 3 major negatives. So all the major negatives for gold are behind us. So, I mean, I don't mean to get too animated over it, but I mean, to me, there's just no bearish case for gold right now. Maybe it corrects a little bit for a month or two, or maybe it goes sideways for 2 or 3 months. But I think the setup here is super, super bullish. And yes, it might take a little bit of time for gold to chew through this resistance up to 1900, 1950. But I mean, I'm super bullish over the next 12 or 18 months.
Yeah, Jordan, I think you laid out a lot of solid points using technicals, using intermarket analysis, and also using the fundamental backdrop. And in spite of all of the what should be headwinds for gold, it still held its own last year better than almost any other asset class and closed the year about where it started. Silver actually closed up a little bit on the year. So there are a lot of positives stacking up for the precious metals. I guess just as we wrap up, I want to go back to the intermarket analysis part of it, because I think that's an area that you really highlight well. And when you talked about gold versus foreign currencies, gold versus the S&P, looking at gold versus other commodities, a lot of investors don't consider that when they're looking at different sectors. They only look at nominal pricing. And it's easy with technical analysis just to get stuck looking at only nominal pricing. Why do you put such an emphasis on intermarket analysis? And then how will that tell you when you're really in a real gold bull market?
Well, I mean, the real indicator when you're in a real gold bull market is gold outperforming the S&P. I mean, people looking at charts, you can look at gold's performance against the S&P. Look at it in the 1970s, look at it in the 2000s, those decades. You can see how well gold performed. And that's the difference between a secular bull, and you can look at other periods where there's been cyclical bulls like 2016 to 2018 or 85 to 87. But that's really the simplest thing to look at. And so with respect to intermarket analysis, I mean, it's really important for two reasons. I mean, first, it's a leading indicator for the gold price in nominal terms. I mean, gold against the S&P, gold against foreign currencies, those tend to be great leading indicators for the gold price in dollars, the nominal gold price. And gold typically, in real terms, gold typically starts to strengthen in real terms around major turning points. And I mean, that's what we've seen in the last several months or a year or so. I mean, for example, gold against the S&P 500, that ratio bottomed right when the S&P peaked, when the stock market peaked in early 2000. I mean, the bull market still didn't really start for another year, but that bottom, gold against the S&P, it bottomed like a year before it. If we look at now, gold against the S&P 500, I'm looking at it right now. When did that bottom? It looks like it bottomed exactly 12 months ago, basically. When did this bull market start? Probably about 2 months or so, give or take a few weeks maybe. So that's just one example there. It's just, these are great leading indicators for gold. And the other reason it's important is because gold is the type of investment where to do well, it has to really be outperforming everything. I mean, if you're looking at the stock market in certain sectors, I mean, the energy sector can still do well if, tech or financials are doing well, but gold is different in that if there's enough sectors in the stock market doing well, or the stock market as a whole is doing well, I mean, you just can't have a real bull market in gold, because then too much capital is flowing into conventional investments. It's also the same thing with the bond market. I mean, yes, the bond market did well during the 30s and the 2000s, but because the bond market was doing well then, that's why gold didn't have the type of bull market that it had in the 70s. And so that's why intermarket analysis is so important, because you can decipher how gold is performing in real terms. And if it's outperforming everything like it's starting to do now, that's a signal of a real bull market. And the third thing actually is when gold's outperforming everything, that's a good sign for mining margins and the profitability of miners, like the future margins over the coming quarters. Because when gold is outperforming commodities, when it's outperforming oil, et cetera, that's a good signal that mining margins are going to strengthen and that miners are going to outperform gold. Now, when you get to the latter part of an economic cycle, or maybe the middle part of it, when the economy starts to do better and maybe there's more inflation in the oil price and inflation in materials, that's worse for gold. And the real price of gold really weakens as that starts. And that's cyclically, that's bad for gold. And it's then you see miners really starting to underperform in real terms. So there's multiple reasons why looking at intermarket analysis and gold versus everything, why it's so important and crucial.
Some really great points for investors to consider as you look at other markets in relation to one another and which one really is getting the traction. And gold is a bit of an outlier in that it shines the most when it's outperforming everything else. And that usually means everything else is in a tough spot. And that seems to be the environment we're setting up for in 2023 and possibly moving into the year after. So we'll keep tabs on the big picture. I appreciate you sharing some of the short-term targets as well. And looking forward to our chat again next week, Jordan.
Sounds good. Thanks for having me.